Fellow risk takers, this is your worst. Podcast host Andrew Stotz from A Stotz Academy, continuing my discussion with Larry Swedroe, who for 3 decades was the head of research at Buckingham Wealth Partners. You can learn more about his story in episode 645. Larry stands out because he bridges both the academic research world and practical investing. And today, we're diving into a chapter from his recent book, Enrich Your Future, The Keys to Successful Investing. And the chapter is chapter 22, and it is Some Risks Are Not Worth Taking. Larry, take it away.
Yeah, so as we always do in my book, we begin with an analogy that has nothing to do with investing to help people understand the difficult concept. And the analogy I came up with for this chapter to help think about what risks in investing are not worth taking is from one of my favorite books by a fellow named Lawrence Gonzalez called Deep Survival, about how to survive in the wilderness, for example, if your plane crashes or something. And he described this particular situation. He said there were 8 snowmobilers that had just completed a search and rescue mission. They stopped at the base of a hill well known for climbing and what was called hammerheading. Hammerheading is where you race up this hill until you get to see how high you can go on that hill. Okay. And the one who wins is the one who can get up the highest. This particular hill, though, was known to be dangerous, that avalanches could be caused. Now, these are professionals, number one, who should know better than anybody and should know what risks are worth taking or not. But of course, their confidence in their skills could lead to that all too human trait we've discussed before called overconfidence. And 2 of the 8 couldn't resist. One of them went up quickly, and then the other said, well, if he's going, I'm going to go too. Unfortunately, the sound of their engines triggered a avalanche, and both of them died. That's what we mean by that there are some risks that clearly are not worth taking because the consequences of being wrong, if the risks show up, are so bad that you should never take the risk, regardless of what you thought the odds were. Let's say these people said, yeah, could be an avalanche, but it's a 1% chance. It's just not going to happen. Well, if you did it 100 times, one of those 100 and you're dead, you know? So then how does this relate to the world of investing? This was around late 99, early 2000s. I was a consultant to a registered investment advisor in Atlanta. And one of their clients was a very senior Intel executive. And this executive's net worth was about $13 million. Almost all of it was in Intel stock. And he was confident, of course, that this stock was the best company. It was, in fact, you might think of an analogy here, it was the NVIDIA of its day. It was the chips that was powering the whole dot-com revolution. Okay. Trading spectacular levels. He had watched it go up and up and up. And I pointed out that there were similar situations not all that long ago, from the 60s, for example, when we had the Nifty 50 bubble. And once great companies like Xerox and Polaroid and Kodak and many others disappeared, even great computer companies who led the whole innovation era in computers like Data General, Digital Equipment, they were gone already.
Mm.
And these were among the leading stocks. And he was convinced that because he was a senior executive, he would know. And I pointed out to them that some risks are just not worth taking. You have $13 million. Sell it all or most of it, and then just build a nice, safe, diversified portfolio, mostly even bonds. You could withdraw $500,000 a year from it pretty safely, or maybe more in those times because interest rates were higher. And that was far more than he needed. Didn't matter, couldn't convince him. Within literally like a year or so, if my memory was correct, the 13 became 3, and the stock has never recovered, even 30 plus or roughly 30 years later now, to that price. That's an example of some risks are just not worth taking, regardless of what you think the odds are. And whenever I have stories like that, I'm always reminded, I think, correct me if I'm wrong here, Andrew, but I think we've discussed Pascal's wager before. Uh, so that's where Blaise Pascal, the mathematician, said, look, you can't prove whether there is a God or not. It's a belief. So how should you act given that you can't prove it? He said, well, think about the consequences of your action. If you believe there is a God and you're wrong, what's the consequence? Well, you led a good life. You on your tombstone will say he was a good father, good husband, great friend. Maybe you missed out on a few good frat parties or stuff like that,
Because you
but you
followed a
had a
code
good
of
life.
ethics that was built around that religion, let's say. Yep.
Yeah, right, exactly. On the other hand, if you believe there is not a God and it turns out you're wrong, then at least according to Christian theology, you're doomed to burn in hell for eternity. So it doesn't matter what you think, because the consequences of being wrong are so bad, you should act as if there is a God. And that's the mistake this Intel executive made. He should not have said, I think this is a great company. Odds are great. It doesn't matter. You should think about the consequences of being wrong, because none of us has a clear crystal ball.
And I think I've also told the story of the advisor that worked with my mom and dad when they first retired, or went to North Carolina and retired there, because my dad had a portfolio that was probably both, my mom and dad's portfolio was probably 70 or 80% DuPont stock,
Mhm.
because they had been given incentives to buy it where they were buying it
That's
at below market prices. So my
Was
dad
this
knew that was
before or after the Bhopal incident?
uh that's a good question. This was 1992, so I can't remember. Bhopal was probably before that.
I think that's
Yeah.
true. Yeah.
But I think wasn't Bhopal Union Carbide? I can't remember
Or
now. But
maybe it was Union Carbide. You may be
yeah,
right.
but the point was that they went to meet this financial advisor, and they said, "How can you help me?" And he said, "Well, first thing I'm going to do is I'm going to reduce that DuPont stock in your portfolio." And my dad said, "Over my dead body, you will." And my mom was sitting there listening to it all, because she recounts this story now at 86. And I tell my students about it because my mom basically said she was listening in and, just observing. And the guy said, DuPont stock's what, 100 or whatever it was at the time. What would happen if it went to, 20?
Right.
You know, and my dad said, it is never going to go to 20. It's DuPont. So next topic. Well, this guy worked hard on my dad, and eventually he reduced the portfolio of DuPont stock, got him diversified. So maybe he had 15%, 20% DuPont stock or whatever it was at the time. And sure enough, my mom told me DuPont stock went to 20. And luckily they had gotten out before that. But, it's just a great example of, no matter how much you love it, everything can go down.
Yeah, and the other point that investors should learn is once you have enough to live the life that you're comfortable with, doesn't mean you get everything you want, but you have everything you need to live a high quality life and enjoy things, right? Why do you want to take the risk of that happening when you have no need to do it anymore? Because the marginal utility of wealth is close to zero once you have enough, whatever that number is. For most people, it might be, they can generate 100 and say 20,000 a year, so it's 10,000 a month. You can't live on 10,000 a month, something might be wrong with your value system. But whatever the number is for you, it might be 20,000 a month or 30. But once you reach that number, why are you taking more risk than you need to take when the upside is not going to change your life in any meaningful way? Maybe you can buy a Porsche instead of an Acura, but that doesn't change the quality of your life in any meaningful way. Or, so why take the risks?
And can we invert this and say when you're young, you should take the big risks?
I wouldn't say should. I would say you have more ability to take the risk. Youth is only one thing in your favor there. You have more horizon, and you have the ability to generate new capital through your wages. But your ability to absorb the stomach acid of the markets, going way up and down should play an important role there.
Mm.
And your ability to take risks should also. And by that, we mean if you've got a stable job, you're a young doctor and you've got a good practice and your income is stable, you want to take some more risk, I'd say fine, because you get another global recession, your income might come down slightly, but it's not going to be impacted in any meaningful way. Where if you're a construction worker or an automobile worker, you could get laid off and out of work for years. And now you have to sell your portfolio to generate cash flow, and then you can't recover because it's been spent already.
And before we wrap up, can you just settle one of the disputes I have with a good friend of mine? His name's Eric, and he always gives the advice, take risks while you're young. And in my book, How to Start Building Your Wealth, Investing in the Stock Market, I say, don't make mistakes when you're young, because the compounding effect of a mistake. Let's say you make a bet, you're 25 and you got excess cash, so you basically give it to a friend to go do a restaurant, and he loses it. Well, you've just lost the potential to have 500,000, $1 million when you're 60. So be very thoughtful about the, mistakes that you could possibly make. But he's like, no, no, the world is clear on this, Andrew. Make your mistakes while you're young.
Yeah, well, I think you're both right and you're both wrong.
Mm.
Okay. You're both right in the sense, or he's right in the sense that you have more ability to take risks when you're young, right? You have more time horizon to wait out. You could take a lot of equity risks. You get a bear market as long as you're employed. The bear markets actually help you because you get to buy more, at lower prices and expected returns are higher. If you were a 25-year-old or say a 30-year-old and and it's 2000 and you've just paid off your debts, your student loans are paid off and the market crashes and now you're first able to invest, that was the best thing that happened. The 30-year-old in 95 in that situation, he's buying at higher and higher prices, right? On the other hand, if you're 65 years old and you're withdrawing, the worst thing that can happen is a bear market early because you can't recover. So one, you do have more investment horizon. So he's right. But you're also right. The cost of being wrong is infinitely higher when you're young because as I point out when I talk to people who evaluate sending your kids, say, to a private school or a good public school, and they say, well, it's costing me, say, 20 grand a year extra. I said, no, it's costing you $1.5 million in your retirement. And that's worth X thousands a year on withdrawal. Now, I'm not telling you shouldn't send the kid to the private school, but you have to think about the compounding and the expected return on that investment. That's the real cost. So you're both right, but you're both wrong in that you have to look at the picture in a more holistic way and not just consider your ability to take risks, which is the only thing he's considering there. And you're looking at the downside without also looking at your ability to be able to take more risk. So you could do that. There's a
And
balance that should be found.
maybe the answer is when you're young, start your investment account,
Yeah.
and start that and start contributing to it. And, but it's not all of your money. You can risk it on some other things.
Yeah, you could take a portion of the portfolio and say, I'm willing to take this portion and put some risk, but start on my plan. And most of it will go into that investment plan that, is a more rational diversification of risks.
These days the stock market's pretty high when you particularly look at the top 5 to 10 companies. And a lot of times we look back at 2000, the dot-com bubble, and compare. But the difference is that these companies are highly profitable now. In those days, companies were really not very profitable. But when you talked about Nifty 50, it made me think that maybe that's a better comparison. For instance, I just was looking at, revenue growth on average for those companies was about 12 to 15%, and ROE was 20 to
Yeah,
30%.
those are
IBM was at,
great companies.
yeah. And so it was just as simply great companies that people were massively overpaying for.
Here's the mistake that most people make, and there's no guarantee here. Okay. all of the research that's been done over 60 years says this, that maybe one of the biggest mistakes investors make is they assume that abnormal earnings growth will persist for a long time. And Fama and French did a famous study on this, I think in 1998, and they found that abnormal earnings growth, both positive and negative, so really bad earnings growth, they tend to revert to the mean at a rate of 40% per annum. So what do we mean, just to help your audience understand this? Let's say, companies are growing with the economy, let's call it 6% a year. 3% growth, 3% inflation. Okay, so you're growing 6% earnings. And you're growing at 26. That's spectacular. So your abnormal earnings growth is 20. That means you should expect on average that instead of 20% abnormal growth, it'll be 12 the next year. So if the economy continued to grow at that 6, you're now going to grow at 18, not 26. And the next year, it'll drop by 40% again. Now, there are the rare companies like NVIDIA that, continue to grow earnings more rapidly. And that's why we see 4% of all the stocks account for 100% of all the risk premium. But good luck trying to find those 4% and be able to buy and hold them through that entire time, and not buy and hold them like Xerox, which was the greatest company maybe of all time in terms of innovation, right? And they're the ones who invented what became Microsoft, for example. Most people don't know that. But their labs out in Palo Alto invented all that stuff, and they just sort of gave it away. But at any rate, those
who was that?
companies
Was there
basically,
research that you saw on that? You were saying
it's Farmer and French's paper.
okay.
You can find it in my books
Yep.
somewhere. I've cited that.
Yep. Excellent. Well,
But I do remember the name because the title is great. It's called Higgledy Growth, and then there was a sequel called Higgledy Growth Again. So if you Google those, you'll see this research was known back in the 60s that this kind of excessive abnormal growth does not persist. Now we know why. Logically, if you have abnormal growth, what's going to happen? It's going to attract competition that wants to get at that abnormal growth. And when you have really bad earnings in industries, what happens? Supply disappears. Companies go bankrupt. Plants get shut. And then supply shrinks, and then profitability can be restored.
oh, so much to talk about. Well, Larry, I want to thank you for another great discussion about creating, growing, and protecting our wealth. And I'm looking forward to the next chapter. And the next chapter is framing the problem. Made me think about the great song by Alex Harvey called "I've Been Framed" that he sang. I don't know if he wrote it, but and then in this you say, in other words, you've been framed. So, listeners out there who want to follow up with Larry, he's got so much going on. In fact, on Twitter, we were just talking about the release of an interesting mashup of a series of podcasts, I think is what you were saying. And so just follow him on Twitter at Larry Swedroe, and you're going to find a wealth of knowledge. He also is on LinkedIn. So just go there. This is your worst podcast host, Andrew Stotz, saying, I'll see you on the upside.